Imagine taking $3.5 billion, piling it into a neat stack, and setting it on fire. That isn't a hypothetical scenario or a dark metaphor for government spending. That is the specific price tag Warren Buffett put on his acquisition of Dexter Shoe. He bought it thinking he had a durable competitive advantage. He was wrong. The advantage evaporated, the foreign competition crushed them, and the investment went to zero. It wasn't a bad quarter. It was a catastrophic failure of judgment. Most people look at the Berkshire Hathaway chart, that mythical line going up and to the right for 50 years, and they assume it's the result of some proprietary algorithm or insider access that you don't have. They see the victory lap. They don't see the scars. The reality is that the Berkshire empire wasn't built on genius. It was built on a paranoid, obsessive system designed to filter out human stupidity. You think Buffett and Munger are stock pickers. The truth is, they are architects of a defensive fortress designed to survive the very things that kill every other business: inflation, ego, and the collective madness of Wall Street. If you want to understand how to actually compound wealth, and not just get lucky in a bull market before giving it all back, you have to dismantle the machine they built. And you have to start with the fact that for the first half of his career, Buffett was effectively a garbage collector. He followed the teachings of Benjamin Graham, buying what they called cigar butts. The strategy is exactly as gross as it sounds. You find a dying mediocre company that is trading so cheaply, it's below its liquidation value. You buy it, you get one last puff of profit as it wheezes its final breath, and then you move on. It works. It's mathematically safe. But it's a grind. You are constantly turning over your portfolio, hunting for the next piece of trash to recycle. If Berkshire had stuck to this strategy, nobody would know its name today. The pivot required an intervention, and that intervention came from Charlie Munger. Munger looked at the cigar butt strategy and effectively told Buffett to stop dumpster diving. He realized a fundamental truth about time. Time is the friend of the wonderful business, but it is the absolute enemy of the mediocre one. If you buy a lousy business, even at a bargain price, time degrades your returns. The equipment rots, the competitors close in, the margins compress. But if you buy a truly first-class business, time does the heavy lifting for you. This shifted the entire philosophy from hunting for bargains to hunting for moats. Now, moat is a term that gets thrown around by every tech CEO trying to justify an absurd valuation. But in the Berkshire system, it has a specific, brutal definition. A moat is a structural economic advantage that allows a company to generate high returns on capital while protecting those profits from the inevitable assault of competition. But here is where most investors lose the plot. There are two types of moats, and confusing them is fatal. The old world ran on tangible assets: railroads, heavy machinery, massive factories. These have moats based on scale. Think of BNSF Railway. You can't just build a competitor to a railroad in your backyard. The barrier to entry is billions of dollars and decades of regulatory hell. That is a tangible moat. But as the economy evolved, the real money shifted to intangible assets. This brings us to the Candies revelation. This was the deal that broke the mold. Berkshire bought See's for $25 million. At the time, the company only had $8 million in tangible assets. On paper, it looked like they were overpaying massively. In reality, they were robbing the bank. See's possessed the holy grail of capitalism: pricing power. They could raise the price of a box of chocolates every single year on December 26th, and nobody cared. They didn't lose volume. They didn't have to redesign the product. They just printed more money. This is the ultimate defense against inflation. Buffett calls inflation a cruel tax that consumes capital. If you run a factory that has to constantly buy new expensive machinery just to stay in the game, inflation eats you alive because your replacement costs skyrocket. But if you own a brand where you can pass the cost directly to the consumer without them blinking, you are inflation-proof. That is the power of an intangible moat. It's not about having the best product. It's about having a product that people are psychologically incapable of switching away from. But a good business model is only half the equation. You need fuel. This leads to the engine that actually powers the Berkshire machine, and it's the part most people find too boring to study: the float. This is the secret weapon that turns a good investment track record into a legendary one. Most people see Geico and think of a lizard and car insurance. Buffett sees a bank that pays him to take deposits. Here is the mechanism. In the insurance business, you collect premiums up front, and you pay claims later, sometimes much later. In the interim, you hold a massive pile of cash. This is the float. For most insurance companies, this money is a liability they are terrified of losing. For Berkshire, it is free leverage. While private equity firms are paying massive interest rates to banks to borrow money for their deals, Berkshire is sitting on over $100 billion of float that costs them absolutely nothing. In fact, because their underwriting is disciplined and profitable, they are effectively paid to hold this money. This capital is then funneled up to Omaha, where it is deployed into high-return businesses. It is a structural advantage that is nearly impossible to replicate because it requires a level of discipline that Wall Street simply does not have. And discipline is the key word, because having billions of dollars in free money is usually a recipe for disaster. This brings us to the institutional imperative. This is a polite term Buffett and Munger coined for a terrifying reality: corporate peer pressure. They identified that CEOs are just like teenagers. If competitor A buys a tech company, competitor B feels compelled to buy a tech company, usually at an inflated price, just to show activity. It is empire building for the sake of ego. It's management doing deals to get their picture in Forbes, not to make you money. Berkshire's entire operational architecture is a giant middle finger to this corporate bloat. It operates on a radical decentralization model that looks borderline negligent to a modern MBA. They have hundreds of thousands of employees across the globe, yet the headquarters in Omaha historically houses about 24 people. There is no legal department. There is no HR department. There are no strategic planning committees wasting time on PowerPoint decks. The managers of the subsidiaries, whether it's Dairy Queen, Fruit of the Loom, or Duracell, are given total autonomy. They are told to run the business as if it were the only asset their family owned for the next 100 years. But there is a catch, and it's a big one. While operations are decentralized, capital allocation is a dictatorship. The cash these businesses generate is not theirs to keep. It is sent to Omaha. This prevents a manager in the furniture division from using his profits to buy a steel mill just because he's bored. It forces capital to flow to its highest and best use. Buffett established a retained earnings test to enforce this. The rule is simple. For every dollar of earnings the company keeps, it must create at least $1 of market value over time. If it doesn't, the money goes back to the shareholders. This acts as a relentless filter against the bloating that kills most conglomerates. It's a system that prioritizes efficiency over size, which is rare in a world where CEO pay is usually tied to how many employees they manage. However, a system is only as good as the minds running it, and this is where Charlie Munger's intellectual framework becomes the differentiator. Munger realized early on that smart people make terrible decisions because they suffer from psychological blind spots. He didn't just study finance, he studied the psychology of human misjudgment. He built what he calls a latticework of mental models, borrowing big ideas from physics, biology, and history to solve business problems. His most famous tool is inversion. It's a simple trick that solves complex problems. Most people ask, "How can I be brilliant?" Munger asks, "Where will I die? I want to make sure I never go there." It sounds like a joke, but it is a profound risk management strategy. Instead of trying to be smart, they focus on not being stupid. They avoid the too hard pile. If a business involves complex technology they don't understand, or if the future cash flows are unpredictable, they pass. They don't try to guess. They wait for the fat pitch. This patience was perfectly illustrated during the dot-com bubble. While the rest of the world was losing its mind over internet stocks with zero earnings, Buffett and Munger sat on their hands. They were mocked. The financial press called them dinosaurs who didn't understand the new economy. The social proof tendency, the urge to copy the herd, was screaming at them to join the party. They ignored it. They knew that speculative manias always end in tears. When the bubble burst and the market collapsed, the dinosaurs were the only ones with capital left to buy the wreckage. This ability to stand apart from the crowd is supported by their view on valuation. They don't use the complex formulas you learn in business school. They don't add risk premiums to the discount rate. They argue that the value of a dollar is the value of a dollar, whether it comes from a bank or a brick factory. They use the risk-free rate, usually the long-term government bond rate, to discount future cash flows. But, and this is the critical but, they only apply this to businesses where the cash flows are virtually certain. If they have to guess, they don't buy. Once they find that certainty, they apply a margin of safety. If a business is calculated to be worth $1, they want to buy it for 60 cents. This gap isn't just for profit. It's to absorb the inevitable mistakes, because they know they will make mistakes. The Dexter shoe disaster proved that. The US Air investment proved that. They know they are fallible, so they build a buffer into the price. It is a humble recognition of their own limitations. This intellectual honesty extends to their circle of competence. You don't have to know everything. You just have to know the perimeter of what you know. Buffett famously stayed away from Microsoft for decades, despite being best friends with Bill Gates, because he didn't understand the long-term economics of software. He waited until Apple became a consumer goods company, a lifestyle brand with an ecosystem that looked more like See's Candies than a tech stock, before he backed up the truck. He bought Apple not as a technology play, but as a consumer franchise with sticky customers and massive pricing power. It became one of the greatest investments of all time, proving that sticking to your circle works, provided you are willing to wait until the perfect opportunity enters it. The final pillar of this system is the specific alignment of incentives. In most companies, executives are paid in stock options. This encourages them to pump the stock price in the short term, cash out, and leave the mess for someone else. It's a smash-and-grab job legalized by compensation committees. Berkshire rejects this. They pay their managers based on a formula that rewards capital efficiency. They generally use a threshold. Managers get a percentage of the profits they generate above a 15% return on capital. This forces managers to treat capital as expensive. It aligns their selfish interest with the long-term health of the company. It solves the agency problem that plagues modern capitalism. If a manager can make the same profit using less capital, their bonus goes up. It turns every manager into an owner. So, what is the actual takeaway from 50 years of unscripted wisdom? It's not a stock tip, it's a way of living. The Berkshire system is a total rejection of the standard operating procedure of the financial world. It rejects the friction of intermediaries, the consultants, the investment bankers, the advisors who exist solely to strip value away from the owners. It rejects the noise of the market, viewing stocks not as ticker symbols wiggling on a screen, but as fractional ownership in real businesses. And most importantly, it rejects the short-termism that defines our era. Buffett and Munger treat shareholders as owner partners. They tell you not to sell. They tell you to think of your shares like a family farm, something you own for a lifetime, through good harvests and bad. This partnership ethos creates a shareholder base that is self-selecting. It repels the day traders and attracts the long-term believers, which in turn gives management the stability to make decisions that might look bad for a quarter, but are brilliant for a decade. In the end, the wealth of Berkshire Hathaway isn't an accident of history. It is the logical output of a machine designed to process reality more accurately than its competitors. It filters out the noise, leverages the patience that others lack, and strikes with overwhelming force when the odds are heavily in its favor. The lesson isn't to copy their portfolio. The lesson is to copy their temperament. To understand that in a world addicted to speed, complexity, and leverage, the ultimate competitive advantage is rationality, simplicity, and the endurance to survive when everyone else is losing their heads. The money is just the scorecard. The system is the wealth.